We're looking at kicks and ships, sports and ports. We're talking Nike and Carnival in today's earnings exchange. And here with our trade is Delano Saporu, New Street Advisors founder and CEO. Delano, welcome back.
Thank you, Kelly.
Let's start with Nike. It reports after the bell. We've been waiting for it all week. These past 2 years have actually been the worst two for the stock since 1997, down nearly 40% altogether. Goldman saying Foot Locker's report is bad news for demand. Direct-to-consumer may not be better because brand momentum has been softening against the likes of On and Hoka. They say China, a similar picture after a strong Q4, macro uncertainty and competition in a key market for them. All of that said, what would you do with the stock here?
Yeah, those are things that are obviously headwinds for the stock. I still like the stock, and I would be buying here. There's a few reasons why. I do think direct-to-consumer has its challenges, but that area is strengthening, and that's a strategy that Nike is looking to obviously move into more. If you look at their most recent report, 15% year-over-year jump in revenues on the direct-to-consumer as opposed to their wholesale side of the business. So, even the shares trading down quite a bit year to date as opposed to, what the S&P 500 is doing. That also is an opportunity, I think, for investors. If you think long term, you believe we'll have a little bit of softness in demand in the near term, but long term that will kind of span out, and the company will continue to grow revenues. I think that's a good trade here for investors, as well as the fact that they're doing well on the dividend yield side at about 1.52% annual dividend yield.
All right, sticking with it. I'm not going to make a just do it pun. We'll just move right along to Carnival, the cruise ship operator tracking for its best year. Believe it or not, its best year since 1998, despite having double-digit losses in August and September. UBS giving a bullish preview, saying comments on volume have been extraordinarily positive, and rising fuel costs have been priced in. But critics warn that cruise lines are among the worst performers in times of high oil prices. What do you do with this one, Delano?
Yeah, not only, some of the worst performers in those times, but if you look at, the cruise line stocks, they've done well so far this year. But if you look at Carnival, it's actually been unimpressive over the long term. And so I think those are one of the reasons why, if you've been in the trade, maybe since the beginning of the year, it's going to get choppy ahead, but you could potentially hold on. There has been pent-up demand for travel, for leisure, for discretionary since the beginning of the year. But that may really, really soften now as we look at either the consumer getting weaker or inflation coming down. One of those two things has to happen. So this is a trade I would hold if someone has a good entry point and is looking to maybe withstand the volatility. But, it could be a profit-taking time for Carnival.
All right, 80% up year to date still, which is pretty remarkable. Pretty high short interest as well. And Carnival CEO Josh Weinstein will be on Squawk on the Street tomorrow morning, 11 a.m. Eastern, to discuss and react to those results. Now, before we go, can we quickly ask about, is it still a meme stock, Blackberry? Well, so they pre-announced earlier this month, by the way. They disappointed on some cybersecurity and tech revenues. The shares are down since then by about 14%. Anything to watch for here?
No, I think the meme rally has kind of died over 2022. It could, this is one that's, I think they have some struggles, as you mentioned, the revenue on the revenue side, the sales cycles, some of those things on with their partnerships, obviously with automakers, probably going to be prolonged with what's going on in that area. But the shifting of the business they've done over the past few years is a tough thing to do. So I'd like to see it play out and probably be sitting on the sidelines waiting for more of that to play out before I would jump into the stock.
All right, let me broaden out then for a second, because you mentioned some concerns kind of about the economy, the markets. So what does that, when you see, for instance, bond yields doing what they are doing, I mean, any temptation here to say, why play around with any of these names? I'm just going to, not T-bill and chill, maybe we're past that. It's like long bond and, I don't know, dream on or something. Are you enticed by those offerings and what could be a softening backdrop?
Yes, really, it's for me barbell strategy in the sense that we're looking at both sides. It could be T-bill and chill. You could looking at, the short term or even long term, and whether it's bonds or treasuries, because you're getting strong yield there. But then, of course, if we see even much more of a correction when it comes to growth, when it comes to tech, which I anticipate we potentially will see, for those people that have been T-bill and chill, they can take some of that cash and take opportunities. But I would wait on the other side of the barbell, on the growth side, for a little bit until there's a little bit more of that potential pullback. But that's probably the best strategy right now for investors if you're looking at the interest rate environment, if you're looking at where yields are, if you're looking at what potentially will have to happen to the consumer to potentially alter inflation. So that's kind of the strategy that I'm keen in on.
All right, Delano, as always, thanks for your time. We appreciate it today.